Good morning, everyone. Welcome to this global rundown for stocks for the 31st of January. If you're a really active market participant, then there's never a dull moment at the moment. It's just a great time to be in the market because every day or every second day there's something very significant occurring and markets are moving around a considerable amount. Um, so the question I posed today, we've obviously seen a big rally from oversold, which was always going to happen, and the question is how far will it run? So that's really the question I want to examine today. and for those of you that didn't see last week's weekly video where I compared the chart patterns in 2008 to the current, then it would be worthwhile going back and having a look at that because there are really some significant similarities between the two. And I guess the key point that I made out of that video is that even in 2008, which was obviously a very, very disastrous year, that after quite a significant plunge in January, similar to what we've just seen now, that the market actually went up and down a number of times, but actually ended up slightly higher in May. So there wasn't this massive collapse in the market. So you've got to bear in mind that even though we might end up dropping into some sort of more substantial correction, that it may take many months to play out, and there could be some quite significant rallies sandwiched in between that. And that's the difficulty, excuse me, of these sort of market conditions. So look, I've got a lot to present today. Again, I'm sorry these videos seem to be getting a little bit longer, but there's just so much to talk about and so much really, really vital perspective that I need to try and get across to you. So these are just some opening thoughts on perspective. The market noise at the moment, by that is I mean this chatter between the bulls and the bears, both of them presenting their cases for whether markets should go up or down, is really getting quite extreme. And similarly, price movements as a consequence are quite extreme. Now, the price movements are being heavily assisted by the fact that all the computer trading that goes on, computer algorithmic trading that happens, a lot of the particularly short-term trading decisions are not made by human beings, and therefore they're not based on the normal human thought process. They're just made by computers that are programmed to do certain things that someone's determined in advance. And we're really seeing massive moves to stock announcements virtually instantaneously. And I read yesterday that the computer programs now are so smart that they actually look for keywords in company announcements and are pre-programmed to respond to them. And that's why when a company releases an earnings announcement or some kind of announcement, that the stock price moves virtually within a second. There's no hesitation. There's no time for anyone to read the announcement, digest the information, think about it, make a decision, and then act. The action is coming instantaneously. And we can't possibly play that game, but there are other games that we can play that can be quite productive. Now, the danger in all this is that your normal investor process gets tossed out the window, and you've really got to avoid doing that, because that's then just trying to play the game that the computers play. So the really big question for me, for investors, is when do you follow the trend? And the prevailing trends at the moment quite clearly are very negative. And when do you observe the fundamentals? Because also quite clearly at the moment, there's a lot of excruciatingly attractive bargains around the world. Yet those stock prices continue to fall and absolutely defy the fundamentals. So those two things are definitely not lining up at the moment. Now, I think your basic case should be that investors should be optimistic long term. That should be your basic position, because the global economy grows, doesn't always grow, but over the long term it grows. There are more and more people, there's more and more consumption. Companies are generally growing their revenues. So therefore, stock markets should expand. They've done so for more than 100 years, and I guess they'll continue to do so for the next 100 years. But within that, we can see spectacular um, reversals in the stock market, anything up to 50%. But long term, you should be optimistic. But what you do need to do is to constantly examine both sides of the debate. The debate at the moment between what the bulls are saying and what the bears are saying. And so therefore, retain an open mind. And I've said that many times. Now, US earnings season, earnings should be the ultimate key driver of stock prices, but at the moment, they're not. The key drivers of stock prices are oil and and central bank policy, and of course computers. But over the longer term, earnings do matter. And US earnings, they're okay against expectations, but those expectations were really low, and the earnings results have really been pretty lackluster in real growth. And even if you strip out energy stocks and materials stocks, it's still not anything to get excited about. And some of the real high growth companies of the last 3 or 4 years in healthcare and semiconductor stock areas, which I think still have enormous growth ahead of them, they're only projecting mid to high single digit growth in the next quarter or two. So the forward outlooks are pretty somber. The oil price continues to rebound, and again, that's not any market goes constantly in the one direction. So some sort of snapback rally was always going to happen, and the correlation that we're seeing with stocks at the moment is almost 100%. Whichever way the oil price goes, stocks go with it, and almost instantaneously. Looking at the oil chart, which will be one a little later, $38 to $40 should provide strong resistance. Now, I'm not saying that oil will get there, but I think if it does get there, then that's quite possibly as far as it's going to go in the short term. Now, all sectors, this is the price reality. It doesn't necessarily match the fundamental reality, but this is the price reality. All US stocks are in long-term downtrends. That means this is not a healthy market. 80% of stocks are in downtrend. That's a shocker. And you could look at that the other way and say, well, what is holding the index up? Because the S&P index is not really off all that much. And the answer is it's just a handful of large stocks. But maybe we're just starting to see a bit of a breakdown in some of those leaders. And Amazon came out with a shocking earnings announcement where they missed their earnings expectations by a long, long way. So maybe that might be another crack in the armor. So the odds favour what we've seen in the last couple of days, this snapback rally, which I think is largely about short covering, it's a counter trend rally at this stage. I think that's really what you have to say. Now, the normal market patterns are just being messed up by forced selling by the hedge funds. That was in early January. And then just erratic trading by the computer programs. So what we're seeing now is not a normal market. Now, turning to the American market, the S&P ended up higher by 33 points for the week, but that was all on Friday night. Almost the entire week gain occurred on Friday night, despite the fact that the reversal started on Wednesday. Now, that reversal was about oil, the oil price going up, went from 26 up to 33. And then the Bank of Japan decision on Friday to basically go into negative interest rates. So they've joined the ECB in that same crazy policy decision, which just has to play out really, really badly over the long term. So that then just fueled further buying of stocks. The Japanese market was up about 2.5%, and that certainly fueled that big rally in the US on Friday night. So basically, the bottom line, markets were oversold. They had to bounce, and oil and the Bank of Japan decision were the triggers that caused that to happen. Now, we've got key resistance coming up at 1945, 1978, and then 2000. We'll look at that on the chart in just a minute. And as I said last week, whether this is a bear market unfolding or not, I don't know at this stage, and I'm not prepared to have an opinion. But what I can say is that the character of the market has changed quite clearly, and we'll see that on the chart. And we'll also know from last week's video when we looked at 2008, and also the same pattern occurred in 2000 before the big bear market there, is that it requires quite a few months for confirmation of the bear market. The market just doesn't roll over into a bear market and just go down and down and down. We get an initial break and then you get a rally back. It happens every time. So we're not going to have resolution of this until April, May, June of this year. So don't expect this to come about quickly. I just mentioned the Bank of Japan and the crazy central bank policy. I just thought I'd flash this chart up. This is the Bank of Japan assets on their balance sheet. Now, if you're not sure what that actually means, it doesn't really matter. It's just central banks are massively expanding the amount of money that they're printing and putting in the system. Now, again, this is the scale over on the left-hand side is in hundreds of millions of yen, but so we'll just call them units. And you'll notice from just before 2000 up to about 2006, in an effort to try and stimulate their economy, the Bank of Japan increased their balance sheet. They basically doubled it from 800,000 units to 1,600,000 units. There was then a bit of a pullback through 2007, 2008, and then you can see since the Prime Minister Abe has come to power in 2013, it's gone from around the 1,500,000 up. It's more than trebled at this stage. That's just crazy cloud cuckoo land stuff, and it's got to play out very badly. And what it's simply saying is that after 25 years of concerted effort to try and kickstart the Japanese economy, that they've gone for this unbelievably massive stimulus, and apparently it's still not enough, because on Friday night, they've just now gone into negative interest rates. So that indicates some real problems in Japan. All right, enough from me. Let's get on and have a look at some of the price charts. This is the S&P on a monthly chart going back to 1998, and you can see this current rally. And whilst we need a few more months yet, you can see the character of the market has definitely changed. This is the little sell-off we got in 2010. This was a bit more of a substantial sell-off in 2011 when we had a bit of a flash crash. But look at where we are now. This has gone on. This is deeper and longer than what we've seen previously. Whether it will result in this rolling over as we did in 2000 or as we did in 2008, that's what I've been saying. We need another 3 or 4 months to really determine that. But you must be cautious at this point in time, because that's the reality of what we're seeing. Now let's just zero in. You can see there's been a pretty fair bounce in the last couple of days from the lows, and there's Friday night. So the market had rebounded from heavily oversold, went up to the 38.2% level, couldn't get through it day after day after day, couldn't get through it. And if it wasn't for the Bank of Japan decision, then maybe this market would have rolled over and gone back down again. But the Bank of Japan decision was just enough to really get everyone fired up on Friday night, and you can see how sharply the S&P index went up. So how this plays out, we've got levels, 50% retracement level at 1945. We've got the level up here at 1978, and then of course we've got resistance, which will be provided by these lows from December. So really, it's just a day-by-day proposition. The market is now in the middle. It was oversold down here, had to bounce. It's now how far it bounces, and then what happens when it gets up to these higher levels. That's the key. So really at the moment, you don't want to be taking any big bets either way. That's for sure. Now, just while I'm here, I'll just have a quick look at the Australian market. First of all, the Australian dollar. So we've got this big base forming here in the Australian dollar. We're obviously off a long way from our highs. Got a big base here. We broke to the downside. We're only down there for 2 or 3 trading sessions. That was in the middle of January. And then with the rebound in the price of oil, that's basically brought the Aussie dollar back into its trading range again. But I don't believe that this rebound in oil is sustainable, and therefore I expect to see the Australian dollar back lower again. And I'll just have a quick look at the ASX 200 while we're here. As long-term viewers would know, I think this is a pretty useless index really, because it just tells you basically what the banks are doing and not much else. So you may as well just look at the banks. But you can see clearly in downtrend, the red 150-day moving average line, clearly in downtrend. The price has remained below it. The last time it managed to hold above it was between January of 2015 and June, so the first half of 2015. Since then, the price has remained below it, and it's well and truly turned over. So the Australian market clearly in downtrend. So we're holding at 70.8, and it's really that rebound is just about oil. Our index managed to finish 90 points higher for the week, and will go up further on Monday. But within that, the market is still forming lower highs and lower lows, which is the indication, which is the confirmation of a downtrend. The futures are pointing to our market being 55 points up on Monday, but we'll see what happens. Because there's a lot of overseas selling in our market that is a bit unpredictable when it comes and goes. So the next target for me on the downside is 46.50. I think that's the important thing. Now turning to commodities, gold was a bit higher for the week, $20, but really it needs to clear 1200 to have any hope of getting into some sort of uptrend, and that's another $100 away. And we're still not seeing any movement from gold stocks, which would tend to lead the situation. Let's look quickly at gold. First of all, let's just look at the daily chart first. So you can see on the daily chart, it looks like there's a bit of a rebound happening, and that's what's got the gold bulls a little bit excited. There is a little bit of a short-term uptrend, but my goodness, over the last 4 years, how many of these have we seen? I mean, there was one here, another one here, another one here, another one here. They've just happened constantly over the last 4 years, yet the trend, as you can see, clearly is still down. But you get a more accurate picture when you look at the weekly chart. So you can see, yes, it's gone up a little bit, but we're nowhere near getting into a renewed uptrend for gold. And if we look at the gold index, the HUI index, then you can see there's a little bit happening, but this is just a base. There's no, it's barely made it back above the 150-day moving average. So there's really nothing happening in gold stocks at this point in time. Copper slightly higher to 206. That was really just consistent with a slightly lower US dollar. The big story's been, of course, crude oil, the big rebound there back to 34 from 26.5. But I still maintain that this is a counter trend bounce only, and we've got target resistance at $38 to $40. Some people have been asking me where I think a rational base price for oil is. Gosh, I don't know. This is a bit of a guesstimate. I suspect it's probably going to be somewhere in the mid-20s. I think might be the area where oil finds support, because that is low enough to force enough companies into bankruptcy and therefore curtail production. But it's way below what is a sustainable price. So I believe over the longer term, probably at least 2 years out, we're going to see oil. We have to see oil back above $50. Otherwise, basically exploration will just about hit a wall. So I think 25 is probably a rational basic area for oil. And there's the price chart. It's just a relatively recent one from February last year, so that's 12 months worth of price data. You can see we're still in a very steep downtrend. We're getting a counter trend rally. That's normal, and it's taking stocks with it for the time being. There's the spot copper chart, not a lot of movement in the last week. So just to wrap it all up, um, this is a market that has to be traded from the extremes. There's no point in trying to do something every day. You've got to, I think, consider buying the right sort of stocks when the market is sold off and it's oversold, and to look at exploiting the possibilities of short selling if you know how to do that, when the market reaches an overbought extreme. And there certainly are much more user-friendly ways of being able to play the downside in the market these days. That, if you don't want to short sell and you don't want to go in the options market or the futures market, there are other ways that you can do that. Members obviously understand what those methods are. If you're outside the membership, then that might be something that is of interest to you. I think the important thing here, the important message I'd like to get across is don't lose sight of your long-term plan because of what you see in the short term. That's the mistake that investors make. I think these days we need to be guided more by the chart patterns rather than the fundamentals. That's not the way that it should be, and I don't believe it's the way that it will be over the longer term. But at the moment, it is what it is, and we really should be focusing more on the chart patterns. Just want to wrap it up with a couple of words of wisdom that I've basically learned over many years. We can't control the direction of the market, but we can control what we do about it and how we respond to it. And I think that's the important thing. When we get periods like this, a lot of investors and traders get confused, despondent, frustrated, and they just really don't know what to do with it. You've got to get past all that emotional response and basically think clearly about what it is that you can do in terms of managing risk and taking control of opportunities. Because with markets moving around as they are, you can't say that there's not unbelievable opportunities. It's just you need to know how to go about it. So panic is not an investment strategy. That's a lot of people do. And the reality is that you do need to rebalance your portfolio and your approach from time to time. This is not a world where you can set and forget, buy and hold anymore. Can't be done. You've got to, regularly be examining what you're doing and changing your methodology or amending your methodology to suit the circumstances. And I think you also need to acknowledge that from time to time, you're going to be wrong about your outlook. You might think that we're heading into a negative period and the market does something different. So you just need to be open-minded, recognize that you are going to make mistakes, but just have a plan and be very clear thinking about how you execute that plan. So for members, for non-members, I should say, if anyone would like some assistance, and boy, this is a time where, unless you've got a lot of experience on board, this is where you really do need support and assistance. There are terrific opportunities, there's no question about that, but there is also significant danger in the market. So if you ever needed support, it's now. There's my contact details for anyone outside the membership. Would love to hear from you. That's it for this week. Cheers.